Hello and welcome to Your Financial Planet, a podcast hosted by the Synergy Capital Solutions team. This is the show that brings you portfolio, planning, and financial solutions to help you build, invest, enjoy, and give. Join us as we share our journey as we navigate life's complexities and provide solutions to reduce the noise around your personal financial situation.
Hello, I am Synergy's Director of Investments, Eric Nahat, and welcome to our third quarter 2023 recap and fourth quarter outlook. The investment narrative has evolved throughout 2023. The chart on this slide graphs the S&P 500 and overlays various Google search trends, which allows us to track how that narrative has changed. The peaks indicate that the term had its highest level of search interest at that moment. For example, this year started with investors buzzing about artificial intelligence, or AI. The search term "how to invest in AI" reached its peak in popularity in February as investors researched how to invest in the emerging AI industry. The S&P 500 traded higher as investors raced into AI-related stocks. And then in early March, we saw the failure of multiple regional banks, with the search term regional bank failures reaching peak popularity as investors rushed to understand the potential impact on the broader financial system. As the Federal Reserve stepped in to strengthen bank balance sheets, the stock market bottomed in mid-March and traded higher through the end of July. The search term lower inflation reached its peak popularity in the spring months as data showed inflation pressures easing. However, that inflation relief was short-lived as oil pressures reversed higher over the summer months. The term rising gas prices reached its peak popularity at the end of July, with the S&P 500 trading lower in August and September as investors worried about the threat of persistent inflation. So the third quarter started with rising oil prices, which caused inflation to reaccelerate in August. The rebound in inflation contributed to a sharp rise in interest rates, with the 10-year Treasury yield rising to above 4.5%. The rise in interest rates pressured stock market valuations, and both stocks and bonds ended up down for the quarter. Ultimately, when we look at things from a much longer time frame, there's always going to be something to worry about. This chart shows major news events going back to the Great Depression, but really, if you just think about what's happened over the last few decades, we've had a 9/11, wars in Iraq and Afghanistan. We've had the global financial crisis, COVID-19, multiple recessions. Abroad, we've had Greece, Brexit, the Russian invasion of Ukraine. With all of that, the markets tend to climb a wall of worry to the top right of the chart. We, of course, know that there's going to be peaks and valleys within there, but the importance is staying invested. And to that point, this is one of my favorite charts. It demonstrates that time in the market, not timing the market's what matters. So starting with, say, $100,000 20 years ago, even if you missed just the best 5 days of the market, your returns were more than $200,000 less than staying fully invested throughout that whole time period. From a bond perspective, this slide shows the change in Treasury yields during the third quarter. While the left side of the chart shows shorter maturity yields were relatively stable. They didn't move a whole lot. The right side of the chart highlights the surge in longer maturity yields over the past 3 months. The sharp rise in yields was a big development during the quarter. Excluding the pandemic, the last 2 times the 10-year yield rose by over 0.75% in a 3-month period were 2013 and 2016. So it doesn't happen often. What led to that rapid rise in Treasury yields? One contributing factor was the surge in oil prices and the subsequent increase in inflation. Throughout the first half of 2023, investors believed that falling inflation would result in fewer interest rate hikes by the Fed and potentially quicker interest rate cuts. However, with the economy remaining stronger than expected and oil prices rising, there's a growing realization that the Federal Reserve may need to keep interest rates higher for longer to help prevent inflation from becoming entrenched. Another contributing factor was the increased issuance of Treasury bonds. Following the debt ceiling resolution in May, the Treasury Department can now issue more bonds to fund the growing U.S. government deficit. Treasury bond issuance is forecasted to increase in the coming quarters, and investors are concerned that with the surge in supply, that will outpace investor demand and cause bond prices to decline. For some context, this slide graphs the Bloomberg Bond Aggregate Index's quarterly return since the second quarter of 1976. It shows how rising interest rates negatively impacted bond returns during the third quarter, with the Bond Aggregate Index generating a total return of down a little over 3% after factoring in interest earned. The yellow line shows that bonds haven't struggled this much since the late 1970s, the last time the Federal Reserve was aggressively raising interest rates to combat inflation. Factoring in the third quarter sell-off, 4 of the bond aggregate's 10 worst quarters have occurred since the start of 2022. Well, savers are earning significantly more interest compared to the last decade. The higher interest income so far is being more than offset by falling bond prices. Bonds have played an important role in asset allocation over the past few decades. They're exposed to different risks than stocks and can help protect portfolios against equity market sell-offs. While bonds have weighed on portfolio returns during the Federal Reserve's rate hikes, we believe that bonds still serve a purpose in portfolios. Bonds provide income, and a balanced portfolio can help investors weather a variety of storms, even if diversification presents temporary challenges like we've seen over the last number of months. The Fed is determined to avoid repeating its errors from the 1970s, and the implication is that the Fed may decide to keep interest rates higher for longer. This could keep the cost of capital high, with monthly payments on homes and vehicles remaining elevated. Likewise, businesses may continue to find it more expensive to fund operations, finance inventory, and reinvest in their businesses. Given this uncertainty, it's wise to take a long-term perspective when dealing with interest rates. You could put yourself in a difficult position if you, for example, take out a loan with the expectation of refinancing, only to find that rates remain high. So as we look forward to the fourth quarter, one of the most important things we watch is the U.S. consumer, who is the most important aspect of global growth. With interest rates going up, of course, that cost to borrow has gone up. Businesses are paying higher interest rates on corporate bonds and loans, and from a consumer perspective, they're seeing the increased borrowing costs with interest rates on auto loans, home mortgages, and credit cards all significantly higher. To provide context, the yellow line on each chart shows the average rate over the past 5 years. So rates have significantly jumped, and that rise in borrowing costs represents a significant change from the past decade when interest rates were much lower. New borrowers face higher monthly payments, which changes the math behind how much they can afford. The rise in interest rates will also be difficult for borrowers with variable interest rate loans, which fluctuate based on underlying benchmark or index. Those borrowers that took out loans with lower initial interest rates are now paying significantly more interest. The looming question is whether those who borrow can manage the increased interest rates and maintain their payments, especially if economic growth starts to slow and unemployment trends higher. After a challenging 2022, it's been a good year for investors. Entering the fourth quarter, the S&P 500's year-to-date return has already surpassed the average return for a full calendar year. Several factors will influence how the market finishes this year, including the paths of oil prices and interest rates. Corporate earnings and economic data will also be at the top of many investors' watch lists. The third quarter earnings season starts in mid-October, and it'll provide some key insights into consumer spending and the impact of higher interest rates. On the economic front, investors will be focused on the labor market, the trajectory of inflation, and third quarter GDP growth, which will be released in late October. Our team will be tracking corporate earnings and economic trends throughout the fourth quarter to help guide our portfolio positioning. The market is entering the final stretch of 2023, but there are still a lot of important data points to be released and questions to be answered before we turn the calendar to 2024. So, some closing thoughts. You do not want to let emotion cloud judgment. We very truly understand that investing can be scary for people at times. You need to focus on logic and focus on your long-term planning. There's always going to be uncertainty when it comes to investing, especially in the short term. We expect more variability among returns in stocks. We continue to believe that timing the market is not a viable strategy, and that we should continue to abide by predetermined strategic asset allocation and rebalancing approaches. That means you should not wait to try to find the bottom of the exact market, but instead, new cash assets should be integrated by dollar cost averaging or phasing into long-term holdings over time. As always, should you have any questions or wish to discuss further, please email us at hello@synergycapitalsolutions.com. Thank you.